Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we've put the spotlight on REITs, or real estate investment trusts, and why you should definitely read a bit more about them, listen to, of course, our conversation, and then decide, because they could be a good investment bet for you. Well, we've discussed some of the, the structuring, the taxation issues around REITs. Deepak, I wanted to now get down to the basic question of how to decide which REIT to be in. Like you're saying, there are 4 listed REITs, right? So what all should I consider, factors, before making that decision?
See, broadly, one is investors can invest in mutual funds who in turn take exposure to REIT in REIT. So professionals are doing that work for you. But any retail or HNI investor, when they are considering to invest in REIT directly, probably the factors to look in are, one, let's say, what is the occupancy level in that particular property? Who are the tenant profile of that particular property? Who is the sponsor? Whether the sponsor has given any guidance that they are likely to reduce their stake over a period of time. What is the who is the investment manager? What is the distribution yield which the REIT has paid over the course of last 1 year, and other valuation metrics as to at what discount it is trading to any REIT. Broadly, if these factors investors takes into account, and also based on, let's say, their readings as to whether they expect occupancy levels to increase. These are the multiple factors which probably an investor can consider while investing in a REIT.
Yeah, very interesting, and glad you brought this up, Deepak. Now, how much of this information, things like occupancy levels and, commitment of the sponsor, etc., how much of this is frequently publicly disclosed so that people can take an informed call, Preeti?
Right. So all of this information is available on a quarterly basis.
Okay.
So the results actually carry all of this information park-wise. So it's not just on a consolidated basis, but park-wise. And in fact, if you look at the disclosures that REIT make are so stringent, and therefore there's a whole lot of information available to investors to actually understand the assets, the location of the assets, what are the asset types. So like, for example, today you have 3 REITs which are office REIT, and there's 1 REIT which is a shopping center REIT.
Okay.
Tomorrow there could be more asset classes which can come in. So all this information is very well available on the websites. They are filed with the exchanges. Detailed asset-wise information is available.
Just one more quick point. The 4 listed REITs that we have, do they have very different sizes? Is there sort of some ballpark, average size across the industry? And from an investor's point of view, are you better off with a very large REIT that has investments in multiple properties, or would you want to be in REITs which are more concentrated, say, the South market or the NCR market? How should an investor,
I think that's an individual choice. I think most of the REITs are giving diversification. There are 6 office markets if you look at office REITs in India. And I think most of the REITs are present in at least 3 or 4 office markets.
Okay.
So to that extent,
It's
there
well
is a diversification available. But of course, each of the REITs have some presence which is a little more prominent in a particular market. So I think it's more to be, an individual decision, which market you want to be and which asset class you want to be. But otherwise, I would say that all the 4 REITs are well diversified across a couple of markets.
Now I'm coming to the issue of size, right?
Yes.
I mean, how big are big REITs? And then SEBI's also come out with a framework for small and medium REITs.
Correct.
So help us understand this. Small and medium, the nomenclature seems to indicate that should be good for small investors.
Right.
But that's not really the case, is it? Just explain that to us.
So a large REIT, the conventional mainstream REIT, allows you to make even investment in a unit. So say the units are $300, so you can actually invest just $300. Small and medium REITs, the whole idea to have them, today the investment in these were happening, they were not regulated. You would have a manager who would pool money from a couple of HNIs, HNIs, and pool that together and buy assets. And these assets could be, say, like 1 floor of a particular building or a small building, so to say. So SEBI has actually brought them under a regulatory framework and called them small and medium. But of course, the investment size is much larger. You'll have to invest 10 lakhs. So generally, these could be good for people who want to take exposure to a particular asset or to a particular micro market, and I don't want exposure beyond that. This is one. So those could be, and of course the ticket size is much
10
larger.
lakhs. Your minimum investment is 10 lakhs.
Whereas in case of a Mainstream REIT, you just invest one unit and then
300,
you get
350 rupees, whatever is the individual unit price.
Yeah, so both have their own characteristics.
Sure.
It depends on who the investor is.
Got that. Okay, now let's talk about the mutual fund route. You can also access REITs via mutual funds. So Deepak, help us understand this. What kind of mutual funds invest in REITs, and do they largely look at investments in these big REITs, the large REITs? Or are mutual funds also now considering some investment in these new small and medium REITs? We only have a very few right now. I think just one or two, up and running as of now.
So basically, there are 4 listed REITs, and mutual funds currently have exposure to these 4 large REITs. Mutual funds can invest up to 10% of their portfolio in REIT and in REITs, and up to 5% of their exposure could be to a particular REIT or in REIT. So largely, mutual funds have an enabler in place where they can invest in REIT and REIT in their debt schemes, in their hybrid schemes, as well as few of mutual funds have also put an enabler in their equity schemes. So these are the 3 places where 3 schemes where mutual funds are taking REIT exposure. SME exposure opportunities have not been offered to institutional investors, but we will evaluate them. So let's say, just to give an example, and as Preeti mentioned, let's say in Mumbai market, there are office, let's say locality in Thana, let's say in Goregaon, BKC, Parel, Nariman Point. And let's say if we believe that GCCs are looking to open up spaces, let's say in Goregaon, and probably Goregaon market is likely to do better, then probably we will prefer REIT opportunities in that particular locality. So going ahead, right now the exposure is largely in the 4 large REITs, but going ahead we will evaluate opportunities in case we see merit in them.
All right, but obviously, I mean, the smaller REITs do carry more concentration and therefore slightly higher risk. Great conversation, very, very informative. But I want a quick 30-second wrap on this, Preeti. So remind us why all investors should definitely consider REITs as a part of their investment portfolio. What are the best features?
So I would say liquid, professionally managed, diversified, instruments, ease of buying, selling, and with the moderate risk, moderate return profile, and giving you both stable income and growth.
Okay.
That's how I will sum it up.
All right. Thank you very much. Deepak, thank you for joining in as well. Like I said, it's been a very, very helpful conversation. Opens up a lot of new sort of ideas, food for thought in terms of looking at a brand new product in our investment portfolio as well. With that, it's a wrap on this edition. Keep sending us your feedback, comments, queries. Hope you found this conversation useful. We'll see you again with another theme next week.
Let's talk money.
Powered